Welcome back to the Douglas Social Credit Podcast. Um, you're with Oliver Haydorn and William Waite. We've had a break from from recording that podcast for a few months. We were attended a Douglas Social Credit seminar in Adelaide. Oliver and I were both speakers there, and following that, Oliver's been traveling. Where have you been traveling, Oliver? Sorry.
I was in Qatar, Uzbekistan, Portugal, and then back to Canada. So, yeah,
The cradle of Christianity, you think, in um, Zoroastrian.
that was Uzbekistan. Yes.
Anyway, today I thought we would talk about whether or not our current debt levels puts us in danger of having a general economic collapse, or this prolonged stagnation of economic activity. I'm writing an article on it about the moment, and there are some very alarming signs, I would say. Debt to GDP is very high at the moment, and GDP, as we know, it's a measure of the productivity of the economy. It's not a great measure. There's a lot of problems with it, but it does give you some sense of how much we're building, growing, making, doing. And I just feel that there must be some limit whereby the debt levels and the energy required to maintain the debt levels drags critically on how productive an economy can be. I don't know if there's a definite threshold where the whole thing falls apart like the proverbial house of cards, but it seems to me that at some point, the cost of your money supply, because we have a debt money paradigm, all money is created by the banks as debt. Just to maintain your money supply becomes so expensive that you just can't produce things. You certainly can't produce things that would enable the retention of a high material quality of life, let's say. And I just wonder if we're approaching that point now. What do you think, Oliver?
Yeah, so I thought that perhaps for the benefit of new viewers, but also for those that have been watching for a while, we might take a bit of time to look at Douglas's analysis of what's wrong with the financial system. Because in order to understand why there is so much debt and why it's constantly increasing, we have to look at what the origin of that is, or what the main cause is. And Douglas said many decades ago, over 100 years ago now, that under the existing financial system, because of the nature of cost accountancy, but also because we run on a debt-only paradigm, as you were saying, we're forever generating costs and prices in the economy at a faster rate than we're distributing incomes to consumers. So there is an inherent systemic built-in deficiency of consumer buying power in the form of income in the economy. And what that means then is, because we have a debt money only paradigm, the only way of compensating for that inherent lack of consumer buying power is to rely on some economic agent, government, business, consumers, to go to the banks and borrow additional money into existence, which then, of course, has to have a corresponding trail of debt, right? And that what that means then is that we are attempting to pay off production debts with money that comes from more debt. We're trying to basically pay debt with debt. And that is a losing proposition over time. For one thing, because of the nature of real capital that's tied to machines and equipment, as technology advances, the gap between prices and incomes is actually getting greater and greater as time goes on. And so we need to borrow more and more debt money into existence to compensate for a growing gap. But the very fact that we rely on debt money to fill the gap is itself, by its very nature, it tends to generate a dependency on debt and more debt. And because, it's inflationary. So as costs go up, we have to borrow more and more to cover the increase in the costs. And then people demand wage and salary increases, and there's no end to it. And so because of this, we do reach a point where it's not sustainable. Historically, it has often been the case that when debt levels become too great, the system goes through a period of austerity. And although nothing has happened physically, right, the factories can still produce. There hasn't been a catastrophe in terms of a war or other destruction of let's say, agriculture, industrial capacity. But nevertheless, because of the way the financial system is set up, we're told, well, we can't sustain any more debt, even though we need more money to keep the thing going. So we have basically a controlled demolition where some people go bankrupt, and we wipe those debts out, which then lowers the debt levels so that we can start to run the system again from scratch and go for another 20, 30 years until the next big crisis. But the question now that is before us is this: it seems that the levels of debt are unprecedented. Now, you were talking off screen earlier about the percentage of debt versus GDP in Australia. If you talk about household debt and things like that, maybe you can give those numbers so that we have a bit of a quantitative context for the present situation.
Well, if I remember rightly, household debt was 120% of GDP. National debt, federal government debt of the Australian government is 40% of GDP, and is taking like 1.5% of GDP just to cover the interest charges.
Mm.
And all this is expected to rise. State government debt has exploded. I think it's $800 billion now, accumulated. And of course, then you've got business debt, which is corporate debt, which is sort of, I think, between 30 and 40% of GDP. So GDP, the productivity of the economy, not only does it have to do the jobs that we require it to do, it's also got to service all these debt charges. And those debt charges, because the priority is to maintain the stability of the financial system, they're not really elastic. Like you cover them first before you cover anything else. Michelle Bullock just coming out today saying that people are going to have to start, basically spending less money because the banks have taken it all, and they're going to have to start, buying things of lower quality, for instance. Some people are going to have to sell their houses. Like this is the degree to which they are prepared to protect the claim of the financial industry to the ownership of all money. It's a crazy situation. And going back to the purpose of the talk, is there a point at which it snaps? The tension is too great. And it makes you think about, you can't trust what the pundits are saying, because they're basically paid agents of the system. The salaried economist is going to say more or less what he's told to. And, until the crisis actually breaks, they're going to buoy confidence. That's their job. So you can't, the interest of the institution is wrapped up with how people think about the institution. And if there's a deterioration of faith, then, people start to run for the exits. And we've got these, they're calling it the everything bubble. And this is the inflation of assets in the market. For instance, the housing bubble is the classic one. I think we're running at 10 times the income to housing ratio is running at, house prices are 10 times the average income. Over history, it's been like 2 or 3 times.
Yep.
So that's one bubble. Then we've got the bubble in stocks. I think I could be wrong about this, but I think that a quarter of the value of the stock market is based on tech,
Hmm.
and a lot of that is like whether or not AI is going to be any good.
Hmm.
And
Hmm.
I don't know about you, but there are serious doubts about that. But what I'm saying is that pretty much everyone's saying these things are overvalued, and it's largely as a result of the financial system creating money
Hmm.
and then getting it into the economy by the methods that are available to them.
Right.
People aren't prepared to take on debt to go into business. Like it's way too like of course some people are,
Yep.
but in the main, people are not confident
Hmm.
that the situation is stable enough to take on more debt to go and be productive with it.
Hmm.
So it's getting in any way it can.
Hmm. We might point out something that Douglas, I think, mentioned in The Monopoly of Credit, or might have been also in earlier works, where he says that, uh, you know, the banker, the financier within the present financial system is analogous to an alcoholic insofar as an alcoholic will do anything to prevent the experience of delirium tremens except stop drinking. And in the same way, the benefits
Mm.
which the powers that be derive from the existing financial system, which is a debt only paradigm, the power, the privilege, the wealth that this centralizing system delivers to them is so addictive, if you will, that they're willing to sacrifice anything and everything else before giving up their monopoly and before surrendering um, this convention that money can only ever be created with an accompanying debt. And one of the things that Douglas saw, getting back to this whole idea of there being an inherent deficiency of consumer buying power in the economy, is that we actually can fill that gap with debt-free credit, which then would enable us to pay down the production debts, to cancel them once and for all, rather than
Yeah.
trying to pay production debts with more debt, which is you can't borrow yourself out of debt. It's an impossibility, and it gets worse and worse over time, as we've been discussing, to the point where the debt levels rise so high that it's no longer sustainable. You can no longer take on the amount of debt required to maintain
Mm.
equilibrium, and then it forces a crisis. So you know um, it's unprecedented, right? As far as the debt, as I understand, as far as Australia is concerned, anyway, the debt levels historically are unprecedented, and so we're headed for that.
There's been very high debt levels in the past.
Mhm.
Um, like for instance, during after the world wars, for instance, that was, but not in Australia, but elsewhere, and debt levels are very high there. But I don't think there's been this degree of like complete coverage of debt. Private people weren't in the hole for the Second World War, for instance.
Mhm.
Um, Certainly, it feels like there's a greater degree of debt saturation nationally, like in Australia, but also globally. Like this is and this is the other thing. The thing is so integrated that a failure in one of the main economies like the US, which looks like more likely, for instance, than Australia, has fallout everywhere. I
Mhm.
mean, this whole international idea where we're all integrated and dependent on each other, that's not a condition making for economic stability.
Mhm.
That means that one goes, the whole lot can go, and we saw that in the GFC.
Yeah.
Um, so it certainly looks to me like there's a lot more volatility as a result of debt than ever there has been. I mean, that these levels of household debt are unprecedented. And
Mhm.
of course, if there's a downturn in the economy and people, there aren't the jobs and etc.,
Mhm.
well, she's all got to go, doesn't it?
Yeah. So then the question becomes, is it possible that because in certain respects we are dealing with an unprecedented situation, might it be the case that the powers that be actually intend for there to be an unprecedented crisis, which would allow them to reset the system from the ground up? And we are concerned, I suppose you could say, that one possible way of resetting the system would be to introduce a central bank digital currency system where you basically get rid of the private banks entirely and everyone has a wallet, a digital wallet at the central bank. And we're only using central bank currency, so there'll be no more bank credit. And the problem with that, of course, is that you are replacing a system that, while the paradigm itself was monopolistic and only the banking system could create money and it's a debt only system. Nevertheless, you had a bit of competition because there were different private banks that were operating according to the same strictures. But if you replace that then with a state money system, central bank digital currency system, that's total monopoly. And
Yeah.
with digital currency, you won't be able to transact with physical cash. So there are privacy concerns. There are also concerns with liberty, because it means that if the powers that be don't like what you think or don't like what you do or don't like what you buy, they could theoretically turn your digital wallet off and then you wouldn't be able to buy and sell. So one of the points that we want to make is that Douglas analyzed the root cause of the debt problem many, many, many decades ago, which is this underlying deficiency of consumer buying power. But he also showed what the proper solution is, which is to decentralize the power of money, break the banking system's monopoly of credit, break or do away with the debt-only money paradigm, and create sufficient debt-free credit to bridge the gap, distribute it to consumers directly or indirectly. And the end result of that would be a far more decentralized power and wealth and privilege distributing system, which would be a lot more stable. So the point we want to make is it's not the case that because there are problems with the existing system, that the answer is to further centralized power and increase monopoly. Actually, we could solve the problem along Douglas social credit lines by going in the opposite direction and decentralizing power.
Well, ultimately, the cause of the problem is the centralization of power in the financial establishment. That is the cause of the problem. That's what's actually caused this. Well, the debt thing is a method for bringing that centralization about. And so the undoing of it is to go in the opposite direction, not to run further down that track. Like there's no finer control over the individual than the money power. I mean, people are doing things every day that they wouldn't do for any other reason.
Right.
I mean, that's obvious. And as you said, the decentralization of the money power means to break this monopoly of credit. That means a national dividend that would bridge the gap paid to individuals. This thing that we've got where the financial system has the power to get money cycling by pumping up asset prices. Who does that work for in the long run?
Right.
I mean, we're in an Australia now where they're saying our kids can't afford to buy their own homes. Who's that working for?
Yeah.
So yes, Douglas's analysis and remedy is just the inverse of what we have now in a lot of ways. It's rolling that power back. And really there's no other way to go about it.
Yes. And so in the event of another financial or economic crisis, it's critical that as many people as possible understand the basics of C.H. Douglas's analysis, his identification
Sure.
of the core problem, and also his remedial proposals. Because when these when the analysis and the solutions are seen, they cannot be unseen. And if enough
Mm.
people knew about it, then the powers that be would not be able to sell this narrative that the only solution is to centralize power further in a CBDC system. In other words, they'll come and say, "Well, there's no alternative. This is the only
Mm.
way that we can salvage the system is to centralize, concentrate power even more, and have a CBD system." And that isn't true. If people know that there are, in fact, far better alternatives that have been suppressed for many, many decades, then uh, they won't buy that line. And then
Mm.
once that's achieved, well, I think anyway that it's game over, because it's a confidence trick, I think.
Yes, you're right.
Yeah.
And look, it's not the time to start learning about this after the crisis breaks, because then the issue becomes urgent, and people, history's shown that people are prepared to find relief wherever it is offered once they're in a panic. And of course, this, whatever happens, if there's going to be a general economic collapse, of course the powers that be are going to try and manage that collapse. They're going to try and manage it, and so that when the dust settles, it's them that are still on top.
Mhm.
Okay, so that's how they're positioning themselves now. Now, if we can get the public to understand that it's actually those powers that got us into this mess in the first place, and we can all be reasonable about it now, and
Mhm.
decide that after they break it apart, that we're not going to put the same people with the same stupid ideas back in the same positions, then we might actually come out of this better off than what we went in.
Mhm.
That's the hope, anyway.
Yeah. Well,
And the details of that hope are Douglas Social Credit.
right.
That's
Right. So if there is another crisis, we actually could take advantage of it to
mm,
introduce the Douglas social credit system.
yeah.
Uh, so there's actually an opportunity there to replace the existing system with something that would establish uh, the continuous liquidation of production debts, so that we don't have this ever increasing debt snowball effect that threatens to gain so much momentum that it's out of control and can only smash whatever it ends up running up against.
Mm.
So we have a task. So we encourage our viewers to spread knowledge of Douglas Social Credit, to share these videos, to share the animated videos. We also have two websites. Um, People can get more information. So if you want to give our websites, Will.
The Oliver site is socred.org, socred.org, and I'm at thepeoplescredit.com.au. There's heaps of resources there. There's short animations. There's about 30 of them up, and there are a few more to come. They're all there that provide short, succinct explanations of the Douglas Social Credit plan and analysis. And there's some memes there that we can share on our social media, as well as a heap of other more detailed historical stuff there.
Yeah, so please like and subscribe. Feel free to comment, and we will hopefully see you next week for another episode of this Douglas Social Credit podcast. Thank you.
Thanks for listening.